Hi, and welcome to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm your host, Ray Treverson from OTG Capital. We broadcast locally on Radio Northern Beaches and around the country on the Community Radio Network. So welcome to all of those sister stations out there that are listening to us and taking our feed as well as online through YouTube, Spotify, and a number of other platforms. So it's multi-dimensional, multi-universe, multi-everything. It's brilliant. And I'm really pleased to welcome back to the microphone Justin Bott. He is from Services Australia. You may know that agency also as Centrelink, and I keep dreading on that because I know that's, Services Australia would like to know themselves as Services Australia, Justin, but everybody still knows you as Centrelink. So
yes, for sure. I mean, it's been Services Australia since basically the start of the pandemic as an unfortunate coincidence, I guess, that they almost started at the same time. But it's just, the main message from Services Australia is it's more than just Centrelink. It's Medicare and Child Support Agency, but obviously a big proportion of our time is making sure that our Centrelink customers get the payments they're entitled to.
Wonderful. Now, for those of you that aren't aware, Justin is the Media Services Officer. So Justin has a wide remit, across Services Australia. And so we've covered a whole range of different topics. And today we're going to revisit one because it's very timely, because at this point in time, it's now time for an adjustment in the rates of pay for a number of government payments that go out, including pensioners. And I was looking through some of the material that you sent through to me, Justin. It's not just pensions today, but a whole range of things that surround, a whole raft of services and payments that Services Australia handles. So why don't we cover off the first one in being the age pension? Over to you.
So on the 20th of March and the 20th of September each year, the pensions get indexed. Now, when we say they get indexed, there are actually three standards that they use to work out what the new rate of pension is going to be. One of them is the Consumer Price Index. Another one is called the Pensioner and Beneficiary Living Cost Index. And that is actually a group of, basically think of it as a shopping cart of particular goods and services that may be something that pensioners are particularly going to be focusing on with lower income, make sure these things are covered. And they track how the prices of those particular goods and services have been going. And the third one they standard to is a percentage of the male total average weekly earnings, which is, again, for those that like their acronyms, it's MATAWI. So CPI, the PLBCI and MATAWI are the three criteria that you use. And what the government does is it looks at the movement against those three standards. Whichever one gives it the highest increase, so the biggest improvement, is the one that they use to work out what the new rate of pension is going to be. So that's what's happened. 20th of March has passed, and there's a new rate of pension. So when we talk about pension, you mentioned them. We're talking about your age pension, disability support pension, carer payment. They're all pensions, and they're all paid based on the pension rate and the pension income and assets test. So if I'm a single person, the rate of fortnightly pension, if I'm getting the full rate of fortnightly pension, it's now $1,144.40 a fortnight, which it's gone up by $28.10 a fortnight. If I'm a member of a couple, it's now $862.60 a fortnight each, which means it's gone up by $21.20 a fortnight each. And another big change that's occurred, and this is a combination of CPI but also a government measure, is that if I'm getting rent assistance with my payments, rent assistance, the maximum rate of rent assistance has also gone up by 10%, and then CPI is added on top of that. So that's, if you're getting rent assistance, that's gone up by around $23 a fortnight, as well as those increases in your normal fortnightly payment rates too.
Now, a lot of these indicators and rates, I guess, it's the ABS, the Australian Bureau of Stats, the primary carer of those numbers?
Well, that's where CPI comes from. I'm not actually, I guess that's also where MATAWI would come from. I'm not actually sure where the figures for that pensioner and beneficiary living cost index come from, but it's a standard that's been used for quite a few years now. And I guess the main principle is just simply to say, whichever one gives the best is the one that's used.
Now, I think it's important to note, and again, I've had these discussions with other people, particularly in the tax accounting arena, when the government makes an announcement, for example, where there's a tax write-off. We have to very quickly say to people, that's not money in your bank, okay? And so, just having a tax write-off means you've got to have something to write it off against. But in the same breath, when we're talking about the age pension and a number, and ladies and gents, I've got all the rates here, and there's a ton of things, information, and obviously it's on the Services Australia website that you can download this from the 20th of September. But this is not available to everybody because we have tests, don't we, Justin?
Yes, absolutely. So the first thing is that if you're already getting a pension, it is money in the bank. This will be an increase in the money that's being paid, and it's an automatic process. So a lot of people who've been on the pension for a long time know this. They're used to it. They just know that they're going to see their fortnightly pension rate go up. And in fact, what will happen, again, they'll probably be used to it, is the first pension that you get after the 20th of September is actually going to be a hybrid payment. So don't be surprised that it's not properly reflecting the full change. So the pension is actually worked out on a day-by-day basis. It's not worked out on what are you entitled to over the fortnight, it's what are you entitled to each day. And then that's added up to come up with your 14 days worth of pension rate. So what that means is for the 20th of March and 20th September, there will be a number of days that you have under the old maximum rate, for example, and then there will be a number of days that you'll have under the new rate. So say it's 10 under the old and 4 under the new, and it won't be until your second fortnight that it'll actually be 14 whole days under the new higher rate, and you'll notice that that's your new fortnightly pension rate from there. So don't be surprised that the one in between is not what it was, but it's not what it should be. It's the second one that will always be the proper fortnightly pension rate you're getting.
And I guess it's good that you mentioned that, Justin, because when I look at these, if people simply see the increase column and then they look at their payment, they go, well, hang on, I didn't get the full increase. That's the reason. It's because there's a mix between the old and the new.
Yeah, well, that's
doesn't cut in completely.
That is one of the reasons. But the other thing is that there are a couple of other things that happen on the 20th of March and 20th September. So the first thing that happens, I should say, is that when you increase your rate of fortnightly pension, what that also does is it increases the cutoff points for the pension, so the income and asset limits. You're talking about the fact that the pension is income and assets test, absolutely is. But with the pension, there's an amount of money that you can have where the pension isn't affected. And then the more that you earn in assessable income or the more that you own in assessable assets, the less pension you get until eventually the pension cuts out altogether. Right. Now, when we buff up the pension rate by the power of maths, that also pushes up those cutoff points. So if I'm a single person, then I'm allowed to earn $65,020.80 per annum in assessable income, which is a $56 a fortnight increase. As a member of a couple, I'm allowed to earn $99,382.40 per annum in combined assessable income, which is an $84 a fortnight increase. So we're allowed to earn more. Under the assets test, I'm allowed to have, again, as a single person who owns their own home, it's $695,500 in assessable assets before I lose the pension under the assets test, which is a $9,250 in assessable assets increase. And as a member of a couple who owns their own home, it's now $1,045,500 in assessable assets, which is a $14,500 increase in combined assessable assets before I lose the pension. Now, that's not actually a message for the people that were on the pension. That's actually a message for people that weren't eligible but were very close. So if you were somebody who actually was very close to the pension but was just a little bit too high, with the 20th of September change, you may now become eligible for a pension. So you might now be able to get something. Now, it won't be very much. You'll be just getting your pension. But even if you're only just getting the minimum pension that's payable, you still get the pension concession card. So one of the other messages is not for people that are already on a payment, but for those who aren't, you may now be eligible. So again, as you mentioned, check the website, servicesaustralia.gov.au. Have a look on the panel at the front for whichever payment's the one that's most appropriate for you. If it's aging, then that'll be the one that'll cover older Australians and age pension. And then that will tell you the new income and asset limits. And it will also tell you, if you think you should, then how to actually apply. Now, I'd be hoping that if at this stage you've got yourself a financial professional, that they are also very aware of the 20th of March and 20th September changes, very aware of what your income and asset limits are, and would be encouraging you to lodge the application. So that's the first one. The second thing that I want to mention that happens on the 20th of March and 20th September, particularly for people that are getting a part rate pension, is that that's the time that we also update the value of all your publicly listed shares and all your market-linked managed investments.
Right.
So we may increase the pension rate because of the assets limit, but under our process, and we're perfectly happy with that, the last time we may have updated the value of your shares was the 20th of March, because that's when we do it automatically.
Yep.
We don't, if the only reason your shares have changed is because they've changed in value, not in number, then you're not required to tell us about that. So you don't have to tell us if your shares are going up or down in value, but you do have to tell us if you buy or sell them. So the number of shares changes is a notifiable event. Change in the value is not. So if your shares have consistently grown from the 20th of March to the 20th of September and you haven't told us because you haven't had to tell us, that might mean a significant increase in your assessable income and assessable assets. So although the pension rate may have gone up, if your shares have grown up significantly, that might actually create a little bit of a downward reduction on the pension, depending on what the market's doing. Now, the other thing might occur. If the market's been going down, and this is the first time you've had the update, then your assets have fallen. Again, if you're a part rate pensioner, you're then going to get the benefit of CPI plus the reassessment of your income and assets because the market has fallen and your shares or your managed funds have gone down. So there's other factors that could be at play in affecting the rate, which means you might not get that full amount passed on to you every fortnight, or you even might get more than that. There's a lot of different things that happen on the 20th of March and the 20th of September that interact that could have the reason why your new rate of pension is the one that it is.
Okay. I guess one of the other things that we want to cover off in today's session, Justin, is that you've talked about a number of different factors, and one assumes, I guess, that the Services Australia, when they're making these calculations, they just take a direct feed out of the ASX to be able to link up all the valuations. Is it a reasonably difficult thing for people to update their asset register, or is that something they do online?
That's something you absolutely would do online. And what happens is that if you change, and this is, again, one of the messages that you want to give, because you can come along at any time that you want to and request a revaluation of your shares and your managed investments. So particularly if the market's gone down, we're not going to do it automatically. We only do it automatically twice a year, 20th of March, 20th of September. If the market's fallen, you will eventually get that benefit when the next period occurs. In this case, it'd be now the 20th of March.
Yep.
But if you wanted to get access to, you think that's potentially going to affect your rate and you want to get that sooner, then you can request that revaluation sooner. But it's important to say we don't just revalue the one share that you think has fallen. We revalue all of them across the board. So yes, one may have fallen, but if the other 8 have risen, you're actually potentially making yourself in a worse position. So just make sure that you're aware of everything that's going on.
Yeah, you can't cherry pick, can you?
No, you can't. So and if you do something as simple as changing a bank account, that can also cause us to revalue everything at the same time. So it's actually quite easy for you to get these revalued if that's something that you want to do. Absolutely, online is the best way to do that. It's very quick. You'll be able to do that. Certainly small changes, be able to do it at home without a problem. But even if it's a minor thing, and this is where a lot of people don't actually even think about it, if I have a dividend reinvestment arrangement with my shares, which means that, for example, pick IAG and I get more shares instead of dividends.
Yep.
So my dividends, I've asked them to give me shares instead. Every time I get that, my share number has changed, even if it's only by five, my share number has changed. Under Services Australia requirements, I need to tell Services Australia that the number of shares I have has changed.
Okay.
So even though it's a small one, and even though it happens automatically, because that's what, again, using IAG as an example, I've asked them to do, every time I get that new bunch of shares, that means I need to go online, tell Services Australia that I've got these new shares, and they'll do the revaluations for me then.
Wonderful. Well, look, it's just about time for a break. You're here on Dollars and Making Sense, a weekly show about finance, money and investing. I'm here with Justin Bott from Services Australia, aka Centrelink, and we're going to take a short break and come back to you in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. Hi, and welcome back to Dollars and Making Sense, a weekly show about finance, money, and investing. I'm really pleased to have at the microphone this week Justin Bott from Services Australia. We are talking about indexation of pensions. Now, Justin, before we went to the break, we were talking about how some of the share registers have to be updated manually because if there's a reinvestment scheme that happens, and I'm sure many people that are in the markets, a lot of mum and dads do invest in the share market, they'd be more than likely aware of that. But a lot of it does automatically happen. Now, one of the other things that we were talking about is that because this is not available to everybody, we actually have a starting point and an end point where the pensions that we've been talking about in the first half of the show, they will increment because of CPI and inflation and a whole range of other things that are going on out there. But it's not sort of a cut-off and then it just cliffs off. There's actually a starting point where the pension actually starts tapering off. Can you explain how that works to the listening audience?
Sure. So it's both, and this is a pensions thing. If you're on, other payments don't have this same system. So this is a particular pension arrangement where there is what we call an income and assets free area, which is an amount of income that you can earn or an amount of assets that you can own. And if you're under both of those income and asset free areas, then you're entitled to the full rate of pension. Now, if you have income that's over those free areas or assets that are over those free areas, then the pension starts reducing and it's a sliding scale. So it's pretty much a straight line at an angle, not really complicated. But the basic premise is the more you have, the less you're entitled to, until eventually get to the point where the pension is no longer payable. So again, if I'm a single person, then I'm allowed to earn $212 a fortnight, which is about $5,500 per annum, where the income that I earn, and that's income from all sources, so that'll be deemed interest from financial assets, maybe potentially net rent from investment properties, plus wages, whatever, income from businesses. If it's under $5,500 per annum, I'm basically eligible for the full rate of pension under the income test. As a member of a couple, that figures $372 a fortnight, or about $9,670 or so dollars per annum, where again, my combined income is under the limits. I'm eligible for full rate of pension under the income test. Now, for every dollar that I earn over those limits in a fortnight, the pension goes down by 50 cents until eventually it cuts out at, for a single person, basically $2,500 per fortnight. For a member of a couple, it's $3,822.40 a fortnight combined income. Now, big proviso in that, and we've talked about this in the past, is that if some of that income is from wages or salaries, then if I'm over age pension age, so if I'm on a pension over age pension age, then I get access to the work bonus, which means that on top of the $212 a fortnight for a single person that we don't look at, I'm allowed to earn $300 a fortnight from wages where that doesn't count either. So it's $212 of income from all sources plus $300 a fortnight from wages or income from eligible self-employment. So in effect, that's $512 a fortnight of income as long as there's work in there before my pension's affected.
Right.
And then, so then the more I earn, the less pension I get until eventually it goes.
And I guess with that in mind, given that the tax-free threshold, I'm just going to use rough numbers, is between $19,000 to $20,000. If you are earning that, you're getting that money tax-free. But in effect, because of the numbers that you've just rattled off, it's unlikely then if you are part-time working or you're making investment returns or whatever around that number, you're not going to be drawing a pension then, are you?
Oh no, no, because yes, the tax-free threshold is that rule, but remember we're talking about older Australians, and if we're talking about older Australians, we get access to the senior Australian pension and tax offset, which actually means that my tax-free threshold for a single person is more around the almost $30,000 mark,
Oh,
not
I wasn't aware of
$19,000
that.
mark.
Okay, I wasn't
Yeah,
aware of that.
yeah. So not
Okay,
including.
I've learned something today. Wow.
Yeah, you should
I
certainly
didn't
be
know
looking at your tax rules about your senior Australian pension and tax offset. So the full rate of age pension for a single person is around 24, so it's under 25. It's just under $26,000 per annum.
Okay.
Now, if the tax-free and it's taxable income.
Right.
Now, if the tax-free threshold was only 19 grand, then I'd actually potentially have to pay some tax on my pension. But because of the senior Australian pension and tax offset, which is something the ATO does, it's completely separate from Services Australia. If I'm getting a full rate pension, I'm not earning enough income to warrant paying any tax on that. Now, the cutoff point for the pension is for a single person is 65 grand. Now, I can earn $65,000 and still get some pension, which means that you are definitely in a tax world. You're definitely going to be earning some income. You're definitely going to be paying some tax on that, but you'll still be getting some pension and you still have your pension concession card. So
That's
considering that
fascinating.
the full rate of pension for a single person is around 25, but I can earn 60 and still get a pension, then if I want to work, this is a really great thing because when I'm over old age pension age, nobody's making me work. There's no requirement for the pension that says that if you're on an age pension that you have to. But if I want to work, then I can earn quite a decent amount of money. And yeah, I've got to pay some tax. But I'm still earning in the $60,000 mark, plus some pension, plus a pension concession card on top of that. And if we add the work bonus, that's the equivalent of about $7,800 per annum at $300 a fortnight. I'm talking about more like the $70,000 mark, and I can still have a part rate pension and a pension concession card. So if I want to work, there's a lot of incentive to actually encourage me to do that. And for a member of a couple, it's even more. We're talking about $99,000 worth of income without the work bonus. If we're both working, we both get the work bonus. So that's another $15,500 or so of income that we can earn on top of that. So we're talking about over $100,000 worth of income from, if we're both working, from wages and salaries for eligible self-employment with still some pension eligibility. So people worry that working is actually going to be a negative impact. And it's actually the exact opposite. It's designed to say, if you want to work, your life and your ability to generate income is going to be much more generous if you can choose to do that. You don't have to. Nothing to say you have to. But if you want to, with the work bonus and the way that the income test is working, knock yourself out. Absolutely go for it. And if you actually lose the pension because you're working too much, then again, as a member of a couple, we're talking about over $100,000 worth of income. Right. As a single person, we're talking about over $70,000 worth of income. I mean, realistically, I'm not in a bad position if I'm able to generate those sorts of levels of income and the pension is still payable. So it's actually designed to encourage you to work if that's something you want to do. It's not about making you, but if there's something you want to do, go for it.
And I guess one of the aspects of that is that when we're thinking about work, a lot of the discussion that I see in and around media always refers to, I guess, blue collar kind of work environments. And I guess none of us realistically expect to be swinging a pickaxe after you're sort of 55, 60 odd years old. Certainly I wouldn't. And I'm already around that age group now. But the idea of being able to do white collar work and so those that are in the professions can continue to work. And I guess one of the things that I keep hearing about is this ageism, but I think people with experience are still very much highly sought after if the younger managers out there are wise, I guess, in that regard. But look, one of the other things I wanted to cover off today, we have the income test, which I think we've really talked through quite a lot, but there's also asset types that we want to, and I think we should cover off before the close of the show today. Justin, do you want to cover a little bit about what the assets test does and what it covers and what it doesn't cover?
So same basic premise is there's the amount of assets you can have that doesn't affect the rate of pension. And we're only going to focus on people who own their own home. The figures are bigger for people we say do not own their own home. So there's quite a long list. So again, use the website if you're going to do that, but it's just easier for homeowners.
Sure.
So if I'm a single person, I'm allowed to have $314,000 worth of assets before my assets start affecting the rate of pension that I'm getting. And as a member of a couple, that figure is $470,000 in combined assessable assets before my assets start affecting the rate of pension that I'm getting. And the first most important thing to say is the biggest asset that we, in most cases, do not look at is the family home. So when we're talking about $314,000 for a single person, that's $314,000, not including the family home and the surrounding 2 hectares. It's $470,000 combined assets for a member of a couple, again, not including the family home and the surrounding 2 hectares. Then for every $1,000 worth of assets that I have over those figures, my pension goes down by $3 a fortnight. So if I have $10,000 more, I miss out on $30 a fortnight of a pension. Till again, with that concept of the sliding scale, I lose eligibility at that $695,500 for a single person in combined assets, or $1,045,500 in combined assets for a member of a couple. So when we talk about assets, what we're talking about here is the things that you own. It is actually easier to name the assets we don't count than it is to name the assets we do, because we basically count pretty much anything that you own, both in Australia and overseas. So the ones that we don't look at, the big ones are the family home, superannuation when you are under pension age and it's still accumulating in the superannuation fund. So if I'm 67 and my partner's 64, I'm pension age, my super is going to count. Whether I've moved it into an income stream, kept it into super fund, doesn't matter. It's going to count as a deemed financial asset. My partners, however, because they're under 64 years of age, even if they apply for payment, it doesn't count because super under pension age doesn't count.
Okay.
If I fully prepay my funeral or buy a funeral bond, they also don't count under the assets test for pension purposes, but we're only talking about much smaller figures here. And the gifting, allowable gifting amounts, that $10,000 in a single financial year, but no more than $30,000 that I've gifted away over a 5-year period, they don't count as assets either. But they're the main ones we don't look at. There is another one which is a very specific feature. It's called the Special Disability Trust. It is very specific, and it's only if I want to put money aside to look after a family member like my son or my daughter who has a severe disability and I want to sort of protect their future. That is a very special one. If you have that circumstance, then I really recommend you give us a call and ask to speak to the Financial Information Service about that. That's 132300, 132300, because I have a child with a severe disability. I want to look after them financially after I'm gone. Special Disability Trust is what you want to talk about.
Okay. We're going to wrap up. Justin, thanks so kindly for your time. Remember, Financial Information Services line, ladies and gents, it's free. And thank you for listening to Dollars and Making Sense, a weekly show about finance, money and investing on Radio Northern Beaches and around the country on the Community Radio Network. We welcome questions, feedback. Check out our socials, our blogs and everything. Justin, always a pleasure. And until next time, sir, adios.